Hey guys, welcome to the latest episode of this Unbelievable Life. Today with me, I have longtime friend Clint Bender. I'm so excited he's going to be joining me. I have known Clint for years, and he is one of my top referrals in the lending side of things. And let me just tell you guys, you can't have a successful transaction without a strong, trusted lender. And I want to add to that strong, trusted local lender. And like I said, I have worked with him for years, have known him for years, and he is just, my number one when it comes to lending and helping my clients find their homes and getting them pre-approved. So Clint is a certified mortgage advisor and has been in finance since 2001. I feel like we're dating ourselves by throwing these numbers out there. But since 2001, he's been at closing mortgage loans. He has been closing mortgage loans exclusively since 2007, and he's helped over 2,000 families achieve the dream of homeownership and is licensed in Indiana, Kentucky, Illinois, and Florida. He has been with Fairway Independent Mortgage for 4 years, and Fairway is licensed in all 50 states and is the largest private mortgage banker in the country. His wife, Ashley, is his loan officer assistant. And let me just tell you guys how exciting it is to see husband and wife teams doing their local thing. And they have one son, Blake, age 9, and they reside in Evansville. Today, Clint is going to tell us more about temporary buy downs, which we actually had to do in one of our most recent transactions together. And I can't wait to learn more and how this can be a tool for buyers and actually for sellers as well as we navigate this very interesting home market. Clint, take it away.
Thanks, Nikki. Thanks for having me on today. I wanted to go over to temporary buy downs today. With interest rates rising, they've been going up for about the last 6 to 9 months. You see inflation has been going up. Rates even were over the 7% mark for the first time in probably 10 to 15 years, late last year, early this year. They're starting to go down a little bit, but still, you're still in the 6%, 6 to 7% range on a lot of different mortgage products. And we do think that those are going to go down. So right now, we've got a lot of pre-approved buyers that just would like to wait on purchasing, maybe sign a lease for an extra year, things like that. But the issue is with that is, you wait, home values are rising, you're going to end up paying more for that same home if you wait another year by signing a lease and things like that. So what a temporary buy down does, that allows you to have that lower payment, lower rate for, 1 to 2 to 3 year period. So you can utilize that. And then when rates go down, you can possibly look at a refinance at that point and keep the payment low. So it allows you to purchase a home without waiting, things of that nature. So my favorite to do is a 2-1 buy down, but there's three different types of buy downs. And they can be paid for by the seller or the buyer. Typically, we ask the seller to pay for that. Basically in lieu of paying for closing costs, but there's a certain percentage. But you can do it on almost any type of loan option out there. You have the conventional loan, FHA loan, and VA loan. And we can actually do it on USDA 100% financing as well. But it's typically done on a lot of different conventional and FHA loans. The 1-0 buy down is basically, let's say your rate is 6.5% right now. A 1-0 buy down, you basically buy the rate down 1% for 1 year. The seller would pay whatever the difference is and what the monthly payment difference is on your rate at 6.5% versus 5.5%. The seller actually pays that for you for a year. So that keeps your payment lower. The instance that Nikki talked about that we just closed for some mutual clients of ours, the situation, we did a 2-1 buy down for them. And their situation is they own a home. They need to get it ready to sell, but it's going to take, 4 to 6 months to basically sell it. They need to prep it, do some repairs, things like that. So what we did for them is they wanted to keep the payment lower. So we asked the seller to pay for the buy down for 2 years. So the first year, their interest rate was, I think we locked them around 6.5%. Their rate the first year is 4.5%. The next 12 months, it's 5.5%. And then after they make their 24th payment, on the 25th payment, it'll be back to the normal 6.5% rate. What we anticipate is rates going down to where they could refinance within the first 2 years And the good part about the buy down is you actually still get that benefit. So whatever unused portion of that buy down that doesn't get used towards the payment actually goes on your mortgage payoff to keep the payment lower. So that's the benefit for them is they wanted to fix up the home, move into the new home, keep the payment lower so they can get the house ready to sell. And then once rates, once they sell and rates get a little bit better, they're looking to refinance that and most likely won't have to have an increase in their monthly payment because of the rate or anything like that. So I think it was saving them about $800 a month on the first year, and it'll save them about $400 a month the second year. And then they're wanting to refinance between those first 2 years. So that definitely will help them out and get the payment lower. So that's an option. If you were to sell or refinance during the buy down period, you don't. The best part of it is you don't lose any of those funds that you've negotiated with the seller. There's also one that we offer. A lot of lenders aren't offering this one, but it's actually a 3-2-1 buy down, which means the rate is lower 3% the first year, 2% the second year, and 1% the third year. That one, it's going to be more, you have to have, it's going to be on a higher price loan or a higher purchase price and loan amount there because each loan product has different amount that the seller could pay for a buy down. Like a conventional, typically it's 3%. On an FHA loan, it's typically 6% of the purchase price is what the seller can pay in closing costs. So you can split it. The seller can pay for it all. The buyer can actually pay for some of the buy down as well. But those are some of the options that are out there. We've done all three of them. The most common is the 2-1 buy down. Like right now, I have Nikki and I closed on our clients last month, but I have a client that's looking to close this month. He was looking at properties last year in about the $90,000 range. He ended up falling through because of the property issues, but he wanted to find something a little bit. He couldn't find anything in that price range earlier this year, so he went under contract at a property at $125,000. But the issue is he wanted to keep the payment around the same. So we're utilizing the 2-1 buy down for him. The payment is within $10 of what it was on $125,000 versus $90,000. So he's able to keep that payment lower, and then when rates stabilize over the next year to 2 years, he's able to take advantage of those rates, get a fixed rate, not do a buy down next time, and keep the payment right around the same. So he's able to, finance about $35,000 more without affecting his monthly payment there. So that is another option that's out there. We're looking into that more and more. I actually, like Nikki said, dating myself, when I first got into just straight mortgage lending back in 2007, we did these for about right before and right during the economic collapse, the housing crisis back then. We did a lot of those around that time, but then when rates started to lower around 2009 to 2011, that's when the rates started to go down. You start seeing rates in the fives, and then the fours, and then of course all the way down to the upper 2 range basically. But we didn't really offer that, and lenders weren't offering that back then because rates were so historic lows on a 30-year loan.
And really quick, just to interject, I think this is a very important point to hit on. I think people think this is something new, and it's not. It was not necessary for a number of years, but it was previously used very heavily to get those rates down. We just happened to have a very low period, and a lot of new agents and people that have just been watching the market for the last few years are so used to those lower rates that they have no idea that this is something that was done quite a bit, previously. And it's nice that lenders are returning to an option that opens up doors for people, essentially. So
definitely. And like I said, yeah, we used to do those mainly for FHA loans, but now it's pretty much open on almost all loan types. The down payment assistant loans, like through Indiana Housing that we do and other lenders do, it's not offered through there on the down payment assistance type loans, but pretty much everything else that's out there, we're able to do a buy down on. And there, like I said, there's different options for that. The 2-1 is the main one that people are doing because, you know, 1 year, I mean, it's just hit or miss on whether the rates are going to go down that much, and there's not as much benefit to a buyer to do that. But the 2-1, we're seeing that on pretty much all loan types, and just a wide range of financing options, around $100,000 all the way up to about $800,000 to $900,000. We've seen purchase prices in there with the buy down involved. So it's a really good product. It's not new. It's new to a lot of realtors and loan officers that are out there that have not seen this. And especially if you're a first-time home seller, it's gonna open more doors for more buyers as well. So if you're out there listening and you're a first-time home seller, you're getting ready to put your home on the market, definitely look at entertaining a buy down, especially if it's a higher priced home, because you've got a little bit more payment options in there, and you're going to be able to have more people come through your house and have different options for the financing, because yeah, rates are a little bit higher now than what they were over the past decade, but they're still historically low. Could they get lower? Yes, but with a buy down, you're going to be able to take advantage of that. And then when rates lower, I mean, you know exactly what your worst case scenario is on a payment, but also you have that ability to look to refinance within about 2 years. And then you especially have that benefit to you, where if you sell or refinance in that first 2 years or 3 years, whatever the buy down is, you're going to get that money as a principal reduction basically on the payoff at closing. So you're going to get that reduction as well. So that's a benefit that a lot of more people are starting to see. We're doing more and more. It started to come into about last summer is when we started doing more of these, but you're starting to, explain it to just about every client now that the situation works out for them. Somebody that it doesn't really pay off for is it would be somebody that's looking to only live at a certain place for a certain period of time. It may not be the best option for them, but what I like to do as a mortgage lender is give people options and let them choose. So I usually try to give 3 or 4 options if they qualify for those, just to let them pick, because they're the ones making the monthly payment. I can qualify them, but it's my job to show them, as a certified mortgage advisor, show them the best options and all the options available to them, explain them to them very well, and let them choose.
Like he mentioned, not every agent knows about this. And so me coming from the buyer perspective, when we put that offer in and asked for that, Clint is so wonderful. He will either call the agent on the other side, or he will even create a video to explain this, because, this is relatively coming back. And so it's new to us. But that is one of the things I absolutely love about working with Clint, is that he will take the time and explain it to the other side, so that when we are making an offer, it makes sense and it's competitive. So Clint, thank you so much for everything that you do for my clients. We make a fantastic team. And with that said, we can't wait to bring you our next podcast, which is going to be talking about VA loans, and actually the incentive programs that both Clint and I have, that we have paired up on. So Clint, again, thank you. You're a rock star. Love working with you. Cannot recommend you higher. And thank you to everybody for listening today. Clint certainly has led a very strong, professional, unbelievable life, and he is just number one in my book. We love him to pieces. But again, thank you everybody for watching. Take care and have a blessed and wonderful day.